Good day, everybody. Chris Herline here of Reap Financial. I hope this finds you well. I'm coming to you with today's Wealth Report. It is Friday, July 12th, 2024. And I want to talk to you today about the most underused retirement savings account. It's all about the power of what's called a health savings account. And in our opinion, the most powerful retirement planning tool is probably this health savings account. It's called an HSA. But many people fail to take full advantage of its benefits. For years, I've been broadcasting on KLBJ and KXAN and sharing with our very own clients the benefits of health savings accounts. But what we've seen is health savings accounts are growing in popularity. Just back in 2022, there were more than 32 million HSA holdings, and all was holding about $100 billion in assets. The number of accounts has increased by about 8% each year over the last few years, so I'm encouraged with this data. But anyone whose medical insurance qualifies as a high deductible plan, well, you can have a health savings account. I want you to check with your insurer or employer to be sure that you're HSA eligible before opening one. But if you are eligible, any person can make contributions to your HSA as long as the total contributions don't exceed the annual limit. Now, even employers often make contributions, as do individuals who own the accounts. So if you're looking at getting in the HSA game, or maybe you've already got one open and you're wanting to max this thing out, the HSA max contribution for 2024 is $4,150. And then if you have a family plan or family coverage, you can contribute up to $8,300 this year here in 2024. And then if you're over 55, which many of our clients are, you can do an additional $1,000 catch-up contribution. That's allowed as well. So if you're a family plan here, we're talking about $9,300 here in 2024. Now, if you're on Medicare, it's not that you can't have a health savings account. You may have had one over the years, but contributions can no longer be made to your HSA once you sign up for Medicare. Now, here's one of the top benefits of contributing to these HSAs is that contributions that you make each year are deductible from your gross income. And the contributions made by an employer to the employee's account are excluded from your gross income. So we all like tax deductions. This is why people put money in their 401ks, they put money in their IRAs, and the health savings account also gives you the tax deductible benefit. Now here's the second benefit. The accounts can be invested. We want to make sure that this money's working for you. And these earnings, they're growing tax-free. Now, when you go to take money out of the account and these dollars are used to pay for qualified medical expenses, all the growth, these dollars come out tax-free. A qualified medical expense is one that would be, deductible as an itemized medical expense on your income tax return, and that maybe isn't reimbursed by insurance or another source. But there are well over 1,000 qualified medical expenses. You'd be shocked to see what it actually qualifies as a reimbursable expense. So that's 3 tax benefits. It's a triple tax benefit, and that's what makes HSAs so unique. Unlike your traditional 401ks and IRAs, you aren't just simply deferring taxes. This money's growing tax-free, and unlike with a Roth account, you aren't paying taxes now to avoid taxes later. Money contributed to an HSA is never taxed as long as the distributions are used to reimburse yourself for qualified medical expenses. Another great benefit is health savings accounts. They don't have required minimum distributions during your lifetime like your IRAs or 401ks. Even your spouse can inherit your HSA and have the same benefits as you. Well, it makes sense that most people use their HSAs during their working years to pay for medical expenses, the expenses that aren't paid for by insurance, such as deductibles, co-payments, and non-covered cost. But here's the best strategy of all. The strategy is to fully fund and invest your HSA during your working years. And then when you have a medical expense that comes about, pay the current medical expense from non-HSA sources. So pay for it out of, checking, savings, those type of things. Let that health savings account balance compound for years to come. Compound for your future retirement. Many HSAs can be linked to brokerage accounts to be invested like the rest of your retirement portfolio. So it's not like you're held to a certain array of funds. In most cases, you can invest in a large array of things, whether it be stocks, mutual funds, exchange traded funds, and more. Now, of course, during your retirement years, you can use the HSA to pay for qualified medical expenses, and that includes Medicare premiums and expenses that aren't generally covered by Medicare, such as dental and vision services, hearing aids, and the list goes on. And the expenses don't have to be paid directly by the HSA. This is the really cool part. You can reimburse yourself from your HSA after you pay the expenses. Just keep receipts or keep a running spreadsheet of the expenses, and always do this in case the IRS audits you or the HSA custodian raises questions. But those distributions from the HSA are going to be tax-free when you use them to pay for qualified medical expenses. They also won't be included in your modified adjusted gross income when computing your Medicare surtax, the amount of Social Security benefits to be taxed, or any other stealth taxes that I talk about. These HSAs can be used very effectively. You can use it to manage your tax bracket during retirement and to reduce your lifetime income taxes altogether. A key rule about HSAs is there's no closing date for receiving reimbursement for the medical expenses you paid out of pocket. A distribution doesn't have to pay for current medical expenses to be tax-free. Where I'm going with this is you can accumulate these expenses. You can accumulate receipts of qualified medical expenses that you've paid from your checking and savings over the year, and then down the road, you can pay yourself a retroactive reimbursement check for every expense you've had. There's no limits. There's no time frames. So it gives you a source of tax-free money in retirement. In a retirement year, when you're needing additional cash, you don't have to take it from maybe taxable sources like your IRAs or selling assets in your taxable accounts for capital gains. Instead, you could take a partial tax-free reimbursement from the HSA for qualified medical expenses that you paid for in the past. This strategy allows families to raise additional cash that's off the radar, meaning it's not increasing your tax bill for the year. And this strategy is especially advantageous in a year when your income is already near the top of your tax bracket, or you want to avoid maybe increasing your Medicare premiums. Many people don't maximize contributions to an HSA while they're working because they believe their out-of-pocket medical expenses won't be high enough to maybe exhaust the account balance that they're accumulating in that HSA, or maybe they're concerned they'll have limited access to the money in the future. I want to tell you, don't worry about that. HSA distributions can be used to pay for non-medical expenses. In this case, when distributions from an HSA are used to pay for anything other than the qualified medical expense, the distribution's just included in your gross income and you'll pay tax on it. There's an additional 20% penalty when you're under age 65 and take a distribution for non-medical expenses, so be aware of that. But beginning at age 65, a distribution from the HSA to pay for non-medical expenses will just be taxed the same as a distribution from your IRA would. There's also some great legacy benefits with an HSA that allow you to pass this money tax-favored to spouses and other beneficiaries. Bottom line is, I recommend that anyone who's eligible for an HSA make the maximum contribution to the account. And it's often best to fully fund an HSA even before contributing to a 401k or IRA. We advise people invest the HSA just as they would their retirement portfolio. The strategy will maximize the life of your retirement nest egg. If you don't have an HSA or you're interested in getting in the HSA game, be sure and reach out to your advisor to discuss the options there. We can get those established for many of you at Fidelity and Schwab. That's it for today's Wealth Report. As always, thanks for tuning in with me throughout the weeks. Be sure and catch up on our last Wealth Report. You can click right there on the screen. Until we see you again, all the best to you and your family.